Justice Hennessy, I thought we'd just start where we left off with the list of errata, which we would like to have marked as Exhibit 32.
Thank you very much. Thank you. Very good.
Now, Professor Mintz, we left off at another section of your slides, starting at page 29. You're going to tell us about the logging tax. Would you like to pick up there?
Yes, I think so. So maybe we'll turn to slide 30. So here, we generally looked at revenues that the federal government may have had as a result of taxation or levies that collect rents, and generally we because there weren't a lot, we didn't have to deal with federal expenses very much. But in our review of federal expenses, came across the federal tax credit provided for Ontario logging taxes against federal corporate income tax, and it is kind of an unusual provision because basically what it did was it transferred the payment by the companies from them in terms of their actual economic, maybe not their legal liability as an economist might think of it, or not think of it, but in terms of economic liability, it went from the companies, the logging companies, to the federal government, because no longer basically the logging companies ended up paying less corporate income tax as the logging taxes were credited against the federal corporate tax. And this began, the logging tax started in 1950. And then in 1961, there was a change made where actually it was the 61-62 fiscal year. A change was made where the federal government allowed 2/3 of the logging tax to be credited against the corporate income tax. And Ontario did the same for the other third. And so when I looked at it, it seemed to me that in a sense, all of a sudden, the federal government actually was bearing an expense associated with logging tax. And that expense was lower corporate income tax collections as a result. And so what I went through is then to say, well, what happens if we think of 2/3 of the logging tax revenues that Mr. Hutchings had estimated, which I didn't, outside of dealing with the fiscal versus calendar years issue, but that's a minor aspect, but because it's not calendar year, but it's fiscal year. But if we just leave that aside, we taking those estimates and saying what happens if we take 2/3 of it and deal with that as a federal expense. And that shows up in page 31 of the slides, which we can go to. There we go. And this, what I put in the right column is the actual logging tax paid in RST for to the Ontario government, and I subtracted off the federal cost, based on this credit. Logging tax actually ended, I think, in 1972, was it?
I think maybe
Or 71. But you'll see some amounts afterwards. This is the delays in payments and refunds and things like that. So the numbers are certainly tail off after 70, 71, 72. And computed the total amount. It's not a huge amount involved. We're talking about roughly $2.2 million expense for the federal government cumulatively through that. But I would argue that the logging, that this credit actually ended up being expense in order to support the logging industry, and to avoid really what one might, I wouldn't call it this necessarily, but double taxation through the logging profit tax and the corporate income tax. But certainly it would be supporting the resource revenues that Ontario was collecting. And maybe we'll go to the next slide, 32. In the SIR reply, Mr. Hutchings, he argued that, we said that the logging tax is a resource revenue from 1950 to 62, and then a non-resource revenue from 62 to 1980. And that actually is a misstatement or mischaracterization of what we're saying. I'm not arguing that the logging tax was a resource revenue, but I am arguing that the credit that the federal government gave became an expense for the federal government that'll leave the industry from effectively paying the logging tax.
So the logging tax was a resource revenue to Ontario
Correct,
throughout,
correct.
and on the Canada side became an expense.
Well, it became an expense for the federal government because we're looking at
Yes.
the federal government. Ontario also gave a credit, so effectively, the companies got relief under the Ontario, by Ontario as well, and that was 1/3 of the logging tax. That was the other third. And so we would argue 2/3 became an expense for the federal government and should be netted from the revenue. And for Ontario, they provided 1/3 credit for the logging tax, so you basically got a full credit in the end. And that expense should be netted from the Crown resource revenues as well. And so in the end, although I would certainly agree that between 1950, between the period my slide,
I think if we look at,
between 1950 and 61, there was no similar thing because the logging tax was deductible from the corporate income tax. So companies still had to bear it and still pay it. And Ontario collected it, but it wasn't an expense to the federal government. So from 1950 to 61, but after 1962 to 71, and then with all the back payments going to 1980, at that point, it became an expense to the federal government as well as to the Ontario government at that point. But our focus is on the federal government.
So from 1950 to 1961,
It's okay. So it's
It's a
natural
revenue.
Yeah, it was always a natural resource revenue being collected, but there was no expense being incurred to support that natural resource revenue.
got it, thank you,
And then after 1961, it became a different story.
thank you.
Now, I should mention the reason why the deduction doesn't matter is that in order for, it's like wages and salaries and other costs that are being borne by companies, the forestry companies, in order to, even though there's a deduction from the corporate income tax, so there's a corporate tax savings with the deduction, the company still has to earn income to cover that logging tax. And that income is being subject to tax. So once you calculate the tax savings associated with the deduction, and you include the tax that had to be paid on the income earned to cover the deduction, it nets out to zero. So in that case, but it's still being a resource revenue that's collected by by Ontario. After 1961, what happened was that that logging tax no longer was really being borne by the company anymore because they got a full credit for it. They didn't have to really pay it. There's still revenue that went to Ontario, but it was the federal government that actually paid the tax.
are we ready then to move on to your next topic,
Yes,
which I see on slide 33 is described as specific issues related to estimates of the RST net revenues?
yes, that's right. So I'm going to go into some other theoretical issues. I'm not. I probably will be somewhat brief about this part because there's actually a lot of agreement between us and Mr. Hutchings on some of the issues. The bigger issue in my mind is not the principle that was involved as much as how you carry out the principle and how you deal with it theoretically. First of all, net losses, Mr. Hutchings includes net losses in his valuation of the net natural crown resource revenues.
Net
And,
Crown Resource
or
Revenue.
sorry, net crown resource revenues. And we're in agreement with that. So there's no, we think it was the right thing to do and he did do that. The issue of free land grants and resource revenues, and let me kind of add something in which goes back to some earlier comments that I made. Mr. Hutchings excludes expenses related to land giveaways under various government programs. And principle, I would agree that, that it's appropriate to maybe disallow those land giveaways if it didn't have any impact on the development of resource revenues. Certainly on the current basis, it wouldn't have had an impact. But it would have an impact on future net resource revenues, because as more people came into the area to live, it provided more labor, it allowed more scale to develop for forestry and developments and mining developments. And with that greater scale, then you could have more natural resource revenues collected by the government. And so.
Can I ask this question? I just wanted to go, if someone can direct me to where you are in your report, because I made note of my question there.
Okay,
But you start by saying, by building, I think possibly infrastructure. Then it provided more labor. But in your report, you say it's an expense because presumably, I think you're saying, was intended to bring labor, that. So can someone tell me where I am?
It looks like we're at paragraph 66,
Yeah,
around paragraph
I was
66
gonna ask about the paragraph.
of
Okay,
Professor Mintz's report. Talks about,
Yes,
that the right paragraph?
now this is with respect to if the roads did not directly yield resource revenues in concurrent land sales, and that part I agree with. My argument is that, at that time, in 1850, of course, you didn't have a lot of people living in Northern
Right.
Ontario. It was a very sparse population.
yes,
And once you sort of have the, development with more people, first of all, they're consuming more goods and services, including some of the resources that are there.
mhm,
So that creates more demand. But also they're supplying labor to the industry.
well, I
And that
thought,
allows for more development of future resource revenues that the government can collect. So it's not, I think the main point is that there's not a clear line to draw in that sense, at least the way I
there's
look
not a clear line of that it's a direct expense. But you
Yeah.
say it's an indirect expense. Well, tell me if I'm wrong. I thought what you were saying is this infrastructure, let's say transportation, is
Mhm.
built in order to bring labor
Yes,
and in order to bring people
correct.
there. Well, what if, in fact, the labor that came was imported labor? I mean, brought to Ontario, perhaps by the employer specifically for, as we heard last week, for a paper mill.
Mhm.
And they were brought and the infrastructure was built to support them. It's not that the infrastructure was built first by the government and people came and settled
Oh, I see.
and worked, but rather perhaps the Ontario Paper Company or Kimberly Clark built a town site and brought in labor. And that, in fact, if this is correct, I don't know, consider it, that the services, for instance, the power, was not brought to the people who were already in Northern Ontario. It was brought to this recruited employment pool. Then do you say that the purpose of building those roads was to support the development or to support bringing people in to settle?
Yes.
I just don't know if there's a difference between what we heard last week as a possible way that parts of Northern Ontario developed and what you're saying.
Thank you, Justice. So I think there's two different types of situations here. The first situation is the one that you're describing, which is certainly does happen. You know, you make a discovery, you know, like a mining discovery or you know, or something else, and you have to, you know, you have to get people, you have to import people in to work. You have to build infrastructure in order to help those people. You have to build land. And if I understand what, and maybe I have it wrong, but if I understood what Mr. Hutchings did, he did include roads that went to the mining or the forest areas. At least I hope he did.
I think that's right.
Yeah, and so I think it's quite a and there I would agree certainly with Mr. Hutchings in terms of what he did there. The other one is I'm talking about more of an indirect impact, where you know, the government tries to get more people living in an area, and they're hoping to drive more economic activity that way.
Is that the history of Northern Ontario?
I'm not an expert on the history of Northern Ontario, so I'm
Right.
not sure I want to answer that question. But I'll give you a good example right now. I mean, official federal policy right now is to bring in 500,000 immigrants into Canada.
There
And
are
they-
people who say that
and
there
they
wasn't
look
there wasn't an immigrant in Sudbury since 1945 until that new policy. That you know, just from living here, one might say that policy is noticeable.
Right.
Now.
Yes, and that is the point that I think I'm trying to say in terms of labor, because what I'm saying is that, you know, with 500, I mean, if you look at what the government talks about, they're saying we want to drive more economic growth by bringing in more people into the economy.
Mhm.
And that's the underlying argument for 500,000 more immigrants to come into Canada, that
Yes.
this is going to be helping our economic growth. I could see that in thinking of, you know, in terms of an indirect effect that governments might have in saying, look, we want to develop Northern Ontario by bringing, you know, we'll give free land grants in order for more people to come into the area. And then this way we can drive more economic activity, which also means indirectly, and not all of it, by the way, but indirectly, some of it would lead to more resource development in the economy, because you also have a bigger pool of labor, which goes back to my point about scale. You have more rents when you have a bigger, more inputs that are available to help develop that, you know, to scale up activities. You know, I have to admit, being a Western Canadian and Albertan, my grandparents came before the First World War on free land grants that were given for Saskatchewan, and it's a, you know, part of John A. Macdonald's national policy was to drive more people into Western Canada, partly to prevent Western Canada being taken over by the Americans, but it was also to start developing more the Western economy. And I have to admit, I'm sitting here because of that policy.
Okay. Thank you.
Professor Mintz, where are we on your slide 34 then? Have we?
Well, I think we've had an excellent discussion about the free land grants, and I'm not saying that all the free land grants lead to more future resource revenues, but certainly there's a portion of it that would lead to it, not just those projects that you know were built just to bring, you know, just to expand the project right away. That was my main point. The same point applies really to colonization roads. Again, I agree with Mr. Hutchings that one should limit the cost to relate it to resource development. But again, it's a question of current versus future resource development, which is the point that I'm trying to drive. And then overhead expenses, again, I agree that one should be only apportioning them with respect to the collection, regulation, and support of net resource revenues. But again, there's an issue about what overhead expenses should be included and where you draw the line. And there, I would certainly include a number of expenses. Even going up to, a deputy minister or minister's office, even though it would be a very small amount attributed to a territory, but someone has to cover these expenses. And it would be the relationship of the resource revenues to the total amount of activities, in terms of, let's say, overall, maybe a GDP measure or something like that would be relatively small, but as a port, I would take into account those overhead expenses. And as we discussed earlier on about the importance of rule of law and the cost of capital and development, that it's very that even the justice system, you could make an argument that some of that overhead cost should be covered by, or at least the overhead cost should be covered by everybody. But even with respect to the collection of resource revenues, having a strong justice system, a strong rule of law that allows people to operate at a lower cost in Ontario would allow more rents to be collected and therefore more revenues to be collected, should also be considered as part of the overhead costs. I know that's a broader expansion of overhead costs than what Mr. Hutchings used.
Thank you.
The next slide talks about this value of resources approach, which I think we're back to talking about economic rents. Can you go through that for us?
Well, I think we're gonna get back to kind of very important issue that I discussed earlier on, and that is the whole question of what is the value of resources, and which is different way of looking at which is different than the net crown resource revenues that are actually collected by the government. Those two things will differ. And I'll just quote from Professor Stiglitz and Mr. Hutchings who argued that another way of thinking about economic rent is to pose the question, what economic benefits would not exist if this land with a nickel deposit did not exist? As above, we assume that capital, labor, and other substitutable inputs would earn at least what they could in a competitive market. Therefore, we would subtract the competitiveness costs of input from the value of nickel produced to calculate the economic rents. Now, this is based on a very particular model, theoretical, competitive markets and other things. So it's really more of a notional concept based on simplifying assumptions that economists like to use, like myself as well. And it assumes that all the economic rents might be generated. It assumes that economic rents, in their quote, is only associated with the ore. But as I argued earlier, and I'll talk about this more, economic rents can also go to other fixed factors, of which entrepreneurship is a very important one. And I'll come back to that point. So you can't just argue economic rents are only due to one fixed factor, which is the ore on the ground or the trees are on the land. It can also be due to some other fixed factors, particularly entrepreneurship, which plays a very important role. And the other issue, which I'll get into more detail, is how do you measure rents in historical time periods, especially when you need data on the cost of risk, which I've already talked about extensively with you, Justice, earlier on. But I want to say some more things about that, because that's a really critical issue. Is how do you really evaluate how do you calculate the economic rents where you make sure you've taken out the risk costs, and those aren't constant over time. They will vary over time, which is why it makes it such a difficult concept to, even though it's a nice theoretical concept, economic rents, it's not as easy to actually measure. Maybe we'll go on to
I think move on to slide 37 then, where you start talking about limitations to the value of resources approach.
that's right. So I'm going to now get into that, which is which really gets to some of the last parts of what my testimony is about today. So the value of resources is based on this concept of economic rents. But what I want to go through is that the concept really suffers from a number of severe limitations that really makes it a rather impractical way of trying to assess how the annuity should be augmented, and it's largely due to these limitations that I'll argue that should be the case. And I'm going to cover particularly two arguments, and that is, should rents be taxed at 100%, or can governments tax rents at 100%? And the second being the impact, some of the difficulties in practicality of trying to measure economic rents, which is attempted by a number of people in the past, but it's no simple matter. And as a result, it makes it very difficult to actually apply this approach, that if one wanted to do that. So let me first go through on slide 38, why resource rents are not taxed at 100%. And I'm going to go through several arguments, which are, in my view, quite important. So Professors Stiglitz and Mr. Hutchings asserts that a land value tax based on rents is non-distortionary, and thus is the most economically efficient tax. In principle, I don't disagree with that statement. Most economists would agree that if you can measure them, and if you can set up a tax system that actually can tax them, then yes, actually that could be, one might want to tax those rents. Whether you can go to 100% is another story, and that's what I want to talk about. Now, I'm going to say that the argument is wrong really for two reasons. The first one is something that I hinted at a little bit earlier on, which is respect to the managerial ability of the operating firm, is also a fixed factor. And the implication of that is that some of the rents have to go to the operating company as well. It just can't go completely to the owner of the land. And that's because the entrepreneurship is also another fixed factor that can't be easily replicated. And some of those rents, as a result, end up going to private operators. And contrary, I read the demonstrative slides of Professor Stiglitz, and he talked about all partners providing the same quality of service. But I would argue that not all partners provide the same quality of service, and they have different innate ability that can't be replicated, and that gives rise to some of the economic rent that has to go to the partner.
Wasn't that an assumption?
Of his part?
Yes, that all operators,
Yes,
so it was an assumption. So assume that for the model to work.
right.
Okay,
And what I'm arguing is that's
that
maybe
assumption.
okay in theory, if you want to apply it in theory, but the question would it correct in theory? And I'm arguing, no, it's not correct in theory, because not all partners are the same. So let me, and I'll go into that more later in my next slide. Now, the second point is that theoretically, you can try to tax, apply a tax rate at 100%. That's theoretically, but it's practically impossible to do so. And I'm going to go through in the next slide. I'm going to go through a number of reasons why 100% rent tax is not even a benchmark for how much revenue you can get. And as I mentioned earlier on, resource taxes are not a rent tax. They can help capture the rents, but they can cause economic loss. since the tax applies to all profits, both the normal profits and the economic rent, or the surplus profits that are being earned. It doesn't distinguish, these taxes don't distinguish between the two. And so they could actually take some of the normal profits away from the project. And then the final point I'm going to be making is that no country in the world that I know of, from the ones that I've worked with, have 100% rent taxes. And that's because of the distortions and imperfections in trying that are involved with taxation. And so it's not even a practical concept as well, having a rent tax. So let me now turn to slide 39. And I'll take a little time. One point is going to be somewhat technical. So I'll try to explain. The first point is that, as I mentioned earlier on, most rent taxes, or most rent taxes are not rent taxes, or most resource taxes, I should say, are not rent taxes. And that includes the Ontario mining profit tax, the stumpage fees, and the acreage fees that I talked about later on. And even if a project has no economic rents, when you apply these taxes, that could drive the marginal projects to have negative profits, negative rents. And then a company will decide not to do it. In fact, they'll only pick those projects that earn sufficient income to cover the taxes plus all the other costs, the opportunity costs that they have to cover. So when these taxes are applied, they distort investment decisions as a result. The second point is that no country taxes 100% of the economic rents. And I'm going to explain that a little bit more why, but there are problems in trying to tax rents. It's not a perfect tax. And it's just the way that the world operates today. And that's really, a country that comes closer to, for example, in oil and gas and taxing rents, or with a relatively high tax is Norway, oil and gas. But even they don't have 100% tax rate. And they do try to have it's called a cash flow tax, where a company basically is allowed to write off from their revenues all the costs of their labor and the costs of capital, including an imputed, including in the expense capital. They write off the full cost of capital. There's no interest deduction and things like that because you've already written off capital. So that's equivalent in over time as writing off depreciation and all your financing costs. So that's what a cash flow tax is. And that's used, by the way, for oil sand royalty. It's used for Norway. It's used for the UK oil and gas. It's also used for the BC mining tax, interestingly. Now, that is kind of the closest that you can get to a rent tax, but even they aren't perfect, and I'll explain why in a moment. And no one tries to put on 100% tax rate because it will cause certain distortions and cause investment to fall away. And one of the reasons it will cause investment to fall away is that companies that do get part of the rents because of their managerial ability will go to another country where they can get some of those rents to compensate, because they do have a fixed factor. They're strong companies and they have very well managed. And if they don't get some of the economic rent that they should be due for their innate ability and their excellence in operational excellence, then they will go to a country that does reward them for doing that.
And that has the particular resources.
And has the particular resources.
Can't have one without the other.
Right. You have to have, and they have to have good, there's always the cost of production. It could vary because, some countries don't have great resources, but they do have, a lot of countries do have very good mining resources to develop. But of course, there could be other differences that, that affect the cost of capital or the way that you perceive the quality of the project. Even in the case, this kind of goes back to an earlier comment you made, even the case, let's say you go to a country where, they're hiring child labor,
Mhm.
and, that company,
Blood diamonds.
blood diamonds, they could take on a risk. Going there because someone may come along at some point and make a regulation saying. We're no longer going to import your product because of blood diamonds, as an example. So that's another risk that's imposed in those countries. Luckily, we can say in Ontario, we don't have that. The third point is goes to a point which I want to articulate, which goes back to something raised earlier on and just talking about my PhD thesis. But rents are shared by governments with private operating firms. And the reason the governments do that is that they're trying to attract the best agent to extract the resources. So this goes back to the principal agent discussion I had earlier on. And the concept here is that, the government or whoever is the owner of the resource, you want to have the biggest pie available in terms of rents that could be generated by the resource. And to do that, you need to get the best operators if you want to get a bigger pie to distribute, in other words, or not of rent. And because you need the most efficient operators, you may not know exactly who the best ones are. I mean, some have reputations and things like that, but you don't necessarily know close at hand how the firm operates. Because even large ones, some of them don't do very well in the end because they don't have very good management expertise, or they may not know that particular part of the world or that geological formation that they can really do it well. So the principal, in other words, has a certain amount of or a certain lack of information about who might be the best agent. So what you do is you set up a kind of a contract available.
But sorry, this just gets me to the question I asked last time, which I guess I didn't get. But we don't have a system where the government is hiring agents.
Okay, yes, I shouldn't call it a contract. The main point is that the government announces a scheme, a payment scheme,
Okay.
where it tries to attract the best operators. And usually that will mean that in order to separate the bad ones from the good ones, you have to, have certain signals about them. But one of them is that, but in the end, you have to give them some of the rents in order to attract that agent.
In order to attract resource companies to invest.
Yeah, in order to attract resource companies to invest.
Okay.
And
Got
so that's and that's actually the major sort of consideration here. And it goes back to the point that I was saying about entrepreneurs being in fixed supply, and they're not all equal to each other. In the end, some of that economic rent that's being generated is not due to the ore in the ground, but it's also due to their power, their ability, which is very important to keep in mind. And so that's why not all the rents just go to the ore that's in the ground. And that's a difference between myself and Professor Stiglitz in looking at how the rents get distributed. And empirically, that's what happens. I mean, usually resource companies do get part of the rents because they're getting a reward for the work that they're doing. The fourth point, Justice, is another kind of technical point, but a really important point, especially when you're trying to have a rent tax. So let's say you try to have a cash flow tax that I mentioned earlier on, where you expense all your capital at the beginning. Well, a company doesn't have any payout initially. Let's say you're a mining company, you're making a big investment, putting in mine shafts and all sorts of other things, but you don't have any income yet. You might have international income, on your other projects, but you don't have any income from this project yet until a later time. That's when you start extracting the ore and then you start getting a payout. So there's going to be losses at the beginning, in other words, the cash flow is going to be negative at the beginning. And then later on, it's going to be positive at a later time. Now, when people talk about having, a rent tax and a cash flow tax that I've described, there's always this issue about how you treat unused deductions or losses in your cash flow, your negative cash flow. And one approach is, you just give a check and equal to the tax rate times the cost. The problem with that is, and Canada tried that with the scientific research tax credit. They gave a refundable tax credit, and people took their checks. They didn't really carry out the activity, and they went to Honduras with their check. This actually happened. This was back in the early 80s. I was at finance at the time when this whole controversy was going on at that time. So what happens? Governments often put some limits on losses. The other thing is if Canada's or Ontario is the only one that's giving a refund of losses, and no other country is doing it, well, you can figure out what multinational companies are going to do, and they tend to be the big ones doing the resource development, even Canadian controlled ones like like Teck and others that have been involved in mining. They will work out ways of trying to transfer just through transfer pricing and things like that I'll talk about in a moment. But they will try to shift those losses in other countries into Canada or Ontario, if Ontario paid out refunds for losses. And in other words, companies will try to dump their losses into Canada. And for that reason, and the other thing is that when you start having certain types of losses, sometimes actions taken by a firm might increase the amount of loss. For example, you pay more bonuses to management, or you do other things because it's part of the cost end up being covered by these refunds. And so it may encourage more what's called moral hazard problems. Moral hazard is increasing the probability of a loss happening, or actually increasing the size of the loss, including, as I mentioned earlier on, like putting paintings up on the wall and things like that. So governments put restrictions on losses. And the reason I'm going through all this is that when they do that, they're not fully sharing the risks as you would get with a rent tax. A rent tax would, if you had a perfect rent tax, you would take a certain portion of the rent when it's positive in a year. But if you have negative rents in a year, because there's losses in that year, there may be over time, it'll all be positive, on a present value basis, or, once you take in the time value of money. But in years, you may have negative flow. You may have negative cash flows, like when mining prices drop or forest prices drop or whatever. And if governments don't share that risk, they won't be sharing the rents fully. They'll only be sharing the gains, but not the losses. And that actually imposes more risk on the private producers as a result. And so because of this lack of loss offsetting, you end up getting a rent tax that is not, you can't go to 100%, because what you're doing is you'll be taking all the gains away, but you're never sharing all the losses, especially, if you restrict the use of losses. And so that is an issue that comes up in this sort of situation. And as a result, you can't go to 100% rent taxes is not a benchmark to start from for that reason. The fifth reason has to do with transfer pricing. And transfer pricing is a problem when you get into, multinational companies that have, you have to identify the costs associated in calculating your royalty, or your profit-based royalty. You have to deal either with costs or sales. But let me give a really an example, just in the case of a royalty based on the value of production, you know, on the price being sold. And I've actually dealt with this in some advice that I gave to New Brunswick on redesigning the royalty system a number of years ago. And the problem they faced is the following. In fact, they had mining and they had shale gas and another as their two primary resource royalty systems that they were dealing with. So if you take a case like, which I'm more familiar with, something like mining, and the price that you sell your ore at isn't in New Brunswick. Like there's no market in New Brunswick trading ore. It's another market that's an international market. Could be like in the United States, you know, the New York market or the Chicago market, you know, but somewhere else. And so that's not the price at which the New Brunswick government is basing its royalty on. It's based on the value of the ore at once it's extracted at the pit, basically. That's the way that the royalty is calculated. In fact, that's where you define the value of the ore. But in order to, because that price is not known, you have to kind of figure out what the price is by taking the market price when you take the ore to the market. And you have to kind of deduct costs to get at what the price is at the pit. And those costs are things like your distribution costs. In the case of shale gas, it would be the pipelines of, you know, taking the shale gas out to the market where you could sell it at the Henry Hub price. I know the natural gas market better than the mining market, but the same principle applies. And so then you allow those costs to be deducted. Well, those aren't, you know, the price at the pit is not a perfectly known price. And in fact, there were points that New Brunswick found that when they allowed the deduction for those costs, the price went to zero for the ore at the pit because it was a period when, you know, mining prices dropped, the cost stayed the same. And so the net price at the pit was got close to zero as a result. They were hardly collecting any royalties during those periods. So one has to kind of deal, what is the transfer price or what is the actual price of the ore at the pit as opposed to what's at the market? And that's a complex issue to deal with. And by the way, New Brunswick isn't the only one that faces that. Alberta faces that with the oil sands, because bitumen, when it's extracted from the resource, it's sold in the international market, but that international market is really, you know, the Western Texas intermediate price. And so then you kind of back down values, costs, and quality differences, and a number of other things to get what you call realizations in Alberta, which is somewhat representative of what's called the Western Canadian Select Price. But without going into all the details, the main point is that that price is not known perfectly. So trying to apply a rent tax when you don't know the price of your output is not that simple. And a rent tax also allows certain costs to be deducted. And again, some of those costs, especially on related party transactions between the multinational and its international operations, are not observable in a market. You know, things like paying for innovations or for special technical equipment. There may be no market for it. And so then you have to estimate what the transfer price is. And so trying to have a rent tax is not as simple as one thinks. It's actually, it's a very complex policy to deal with. In fact, I usually, when I go to different countries and recommend reform, I really suggest that if they do have a rent tax like the cash flow tax, that they also have a minimum tax on the value of production, just to at least assure some revenue is being collected in case there's costs are being manipulated that result in not sufficient revenue being collected.
Let me know when there's a good opportunity to ask an overall question, friends.
Well, I think, Professor Mintz, you just have the 6th point to go through. Are you finished with the 5th point?
No, I have to just do, the 6th point is the last point, but I think I can be brief on this.
Well, Justice Hennessy, if you'd like to ask your question now, then go ahead.
So I understood from when I first read the report and then I heard this evidence, you point out the complexities, the difficulties, and the inappropriateness of taxing rents at 100%. But I didn't read the report of Professor Stiglitz as saying, I'm proposing a new tax policy for Canada and they should tax rents at 100%, but rather here is a way of calculating the compensation due for a promise made, not kept. There is a way of looking at it. We have to figure it out somehow. And here's one way of measuring it. And I just didn't ever understand that he was proposing that Canada adopt a new system.
Yeah.
So do all of these problems that you identify touch on what was being proposed, which was a way of calculating compensation or calculating value in order to come up with compensation?
Well, I guess what I'm trying to say is that because rent taxes you cannot really apply them. So first of all, starting with 100% value that somehow the government can collect is not correct. It just can't happen. It's the wrong benchmark. And so I'm not sure I would agree that compensation should be based on something that cannot be done in the first place. So that's really part of the argument. The other part, which I haven't gotten into, is that it's very hard to measure the rents anyway. And so I thought that the initial decision, which is to focus on actual net crown resource revenues, made a lot of sense to me as a way of trying to deal with how to determine the compensation associated with the annuity, because you're not setting up a theoretical model saying, well, this is how we should augment the annuity. You're actually using what was possible or what was done by the governments. Maybe it wasn't perfect, but it probably, at least you can observe the net resource. You can observe the revenues.
Thank you.
So,
yeah,
thank you. Final point, and I'll be brief on this one. It's a very technical point. It goes back actually. I don't know if you ever heard about in Australia, there was a big furor back in 2010. The Australian government wanted to put a rent tax on the mining industry of 40%. They told the industry, don't worry, this won't affect investment at all, etc. And I was asked to participate in a conference, and actually I found a new result and got up at that conference and said, actually, I hate to say it, but the Australian government got it wrong. And the reason is that there's always this problem in governments where you have the resource department, the mining department, or the energy department, depending what it is, the forest department, and they kind of work out their stumpage fees or their royalties and things like that. And it's independent of what the Department of Finance does, which is posing other taxes that it could impact on the industry. And what I showed at this conference was that there's an interaction that goes on between the corporate tax and a rent tax that the Henry report was recommending, and that actually going to 40% would end up even projects that had no rents would end up paying more taxes under this rent tax. And the reason is that the rent tax might share a number of the costs associated with the investment, with the investors. It doesn't share the burden of the corporate tax. And so you get this interaction that goes on between the two of them. It's more complex than what I'm saying, but as a result, you end up actually increasing the effective tax rate, even on a project that has no rents at all. And so, by the way, there was press at all this conference, and I said how the Henry report got it wrong. There were 200 media hits the next day because of what I said. But actually, it was very interesting. There were two discussants, one from Australia and one from New Zealand, who said, first, when I read this argument, I thought Jack was wrong because the rent tax is neutral. It doesn't affect investment, which is kind of what Professor Stiglitz is arguing, and most people would argue. But I thought but after I went through all the mathematics, he's right. and they gave the intuition correctly. So that's reasonable. It's a complex argument, but it's another reason why rent taxes don't go to 100%.
Professor Mintz, can we just go back to your slide 37? Just to frame where we are here on this, because I think your first point there, it might kind of go to the question that Justice Hennessy asked you. When you talk here about the value of resources based on economic rents suffers from several limitations that make it inappropriate to assess how the annuity should be augmented. And then you explain that you're going to cover two aspects, and you've so far now just covered the first aspect.
Correct.
Is that right?
That's correct.
And whether rents would be taxed at 100%, could that also, is that what you're getting at here is, whether the government could actually collect 100% of rents? Is that what you're getting at?
That's what I'm getting at. They cannot do it.
And you think of it in terms of taxing, but another way of thinking about it might be, can the government collect these
Yeah.
economic rents on behalf of the public?
And that's what I'm saying is that they cannot do it.
So the next part that you're going to explain for us as to why this concept of the value of the resources based on economic rents is limited, that's the next thing you're going to get into, other reasons?
Yes, I'm going to get into three reasons. One being risk, which we
Can we
talked-
just ask for a moment before we get into that? I see we've been about an hour. Did you want a break or shall we keep going?
Yes.
Good.
yeah,
We'll
I think
take a
probably
short
half
break
an
and
hour.
come back to that.
We should be able to.
All rise.
We'll recess for 15 minutes. But when I resume, you may be seated.
Professor Mintz, we left off at your slide 40, I believe. Are you ready to
Yes.
start at slide 40?
Yeah, so here I want to talk about not the difficulty of governments trying to collect resource rents, but now talk about the problems involved in trying to measure resource rents. And I want to specifically talk about three things. Really, risk and expectations is really part of the one item, and the other is slides, particularly on inflation, which I'm always amazed when people forget about inflation and the importance and how it impacts on the measurement of profits. But maybe that's because I'm older now, but I remember the days when we used to worry about inflation a lot. So I'm gonna first go to
Everything old is new again.
so if you go to slide 41 on risk and expectations, as I talked earlier on, the trickiest issue is measuring the cost of capital, including risk. The idea being that there's an alternative investment that is of the same risk, but of course, trying to define or find an investment of the same risk as the one that you're looking at, let's say in Northern Ontario, is not something that's easily observed. It's not something that you can easily do it. So as a good example of this, and this is not an argument of it's more of an argument about the problems in trying to do this kind of work. Professor Stiglitz and Mr. Hutchings estimate the cost of capital as the average rate of return on invested capital for companies with only positive earnings before interest, depreciation, taxes, and amortization, 1985 to 2020 at the 75th percentile. And I just happen to remember the one for mining, I think came out to 9.5%.
Okay.
if I'm correct.
And this is a figure from Professor Stiglitz?
Yes, it's from
Thank you.
their working papers, as I recall. So the problem though, this approach, even though it sounds like it's reasonable, it is not reasonable. It's not the appropriate approach at all. Because first of all, it's using ex post revenues and costs to estimate rents, which may simply reflect risk and not economic rent. And that's what I want to talk about. But the bigger issue is that the average, trying to measure the rate of return on capital, whether it's at the 75 percentile, the 90 percentile, or whatever percentile, has no correspondence to the cost of capital. Cost of capital is something else. It's the interest that you have to pay to debt owners, and it's the imputed cost of equity financing that you have to pay to debt owners. And it has nothing to do with the return on capital. So, my comment was it could be higher or lower than the cost of capital. But to give you an example where it could be lower than the cost of capital, just to give you a sense of it, is some work recently been doing with respect to mining. So the long run, one might get into an argument about this, about the exact numbers, but it used to be argued that the real return on investment, that is net of inflation, riskless return, like a treasury bill, in the past used to be 3%. Some people would argue today it's more like 2%, as a long run over several decades, as an example. And if you have inflation, right now it's higher than 2%, but let's say 2% is the long run inflation rate. It's been higher than that, but let's say we take 2%, then you're talking about a government bond rate of 4 to 5%. Then the question is, what do you add on for risk? So some people will measure financial risk, and that number could vary a lot, but the aggregate number that I've worked on over the years, can vary between 4 to 6% on capital. So that would bring the number up to somewhere to, up to as, let's say 10% as the cost of capital. But in mining is actually more risky because of the volatile prices than other sectors in the economy. And in fact, in terms of the risk premium, some of the financial studies had showed that you would add another 30% on the risk premium. So let's say if your risk premium is 6%, we're talking about more like 8% for mining. And so one could be talking about a cost of capital, let's say like 12%, which is much higher than 9.5%. And then as a result, once you subtract off this cost of risk by having a higher cost of equity financing, you would end up getting a much smaller measurement of economic rent. And that's the point about the difficulty. And that doesn't even take into account other risks, that we discussed earlier on, things like technological risk and geophysical risk and political risk, and which is much less important in Ontario, but other types of risks that could be relevant. And so the main point is that this is not to say that there's no economic rents, but it's to say that it's very hard to measure them, because you have to try to measure a cost of capital. And this is the process that should have been used to try to measure the cost of capital, not looking at the average rate of return at the 75 percentile. That's totally arbitrary. It could be 90% percentile. It could be another percentile, because measuring the average rate of return on capital has nothing to do with the cost of capital. It's looking at the other side of the ledger, which is your income statement. It's not asking about your cost of financing.
So the bottom line is the impossibility or the difficulties of measuring cost of capital make the attempt to measure economic rents so fraught it becomes not reasonable.
exactly.
But theoretically, it might be reasonable, but
Empirically, it's.
in trying to apply it, the difficulties are so impossible to overcome.
Correct.
Is your point. Oh, those aren't my words by
no.
myself.
Although I
Okay.
like what you said, but.
Okay, so but just to say,
Agreed.
if I have said it back to
Yes.
you, then I've got it.
Yes, that's exactly. And as I mentioned before, there's regulatory risk, regulatory delay. That's a new one, actually, you know, in terms of you know, the approval for major mining projects. In fact, that's been a bigger issue actually here in Canada because of the problems that are now involved, the regulatory problems in trying to get a project done. You know, there hasn't been, for example, in the past decade, a major mining project in Canada because of regulatory delay and regulatory uncertainty. And that's a completely different risk than financial risk that I went through. So it's, but the main point is that, you know, trying to measure economic rents is, it's a bit of a mug's game, is the way I would put it. Mug's game. I think we can go on to slide 42.
42 on inflation.
Inflation. This is really the last comment, and inflation is, you know, something we, you know, people have forgotten about how important it is. And if you're doing historical numbers, well, I should go back just on the risk point. Trying to estimate risk for every year going back to 1850 is even more of a mug's game. Trying to get that right. Anyway, going back to inflation, inflation has been is an issue. My understanding, and I might be wrong, but from what I've read, and is that actually inflation between 1850 and I think roughly to 1890 wasn't much of a problem. People didn't talk about it as much because it wasn't as historically important. In fact, I read a book by Niles Ferguson on the House of Rothschild, and he had a whole appendix on inflation, and he talked about how there wasn't much inflation in for a significant part of the night, you know, the 19th century, you know, the 1800s,
18.
yeah, 19th
19th
century. Of course, you know, inflation has become much more important today, and it became very important, especially in the 1970s and 80s, when we had inflation in the 5 to 10% period. Well, the problem with inflation is that it distorts the measure of profits. And really, if you wanted to calculate, you know, kind of your economic rents, you also have to measure your accounting profits to account for inflation. And there's three kind of adjustments that you have to do for inflation accounting. The first one is that depreciation has to be adjusted, usually upwards, because depreciation, even for book accounting purposes, which is being used, for example, in trying to measure the average rate of return, as Mr. Hutchings did. Book depreciation is based on the original cost of buying an asset and not the replacement cost of putting in those bricks when the bricks fall out of the building and you have to replace the building or some of the building. So to take an example of that, you know, suppose that you buy a building in 1980 and you're in 2023, you've had 43 years in which we're calculating depreciation on that building today based on the price of that building in 1980. And of course, there's been a fair amount of inflation since 1980. And so if you try to buy some new bricks today to replace the books that have fallen out, you have to pay a lot more to replace the bricks than what the original price was back in 1980. And so that is to say that what people argue that when you correct profits for inflation, you should measure depreciation based on replacement cost, not on the original cost or the original prices of the asset. The price that you have to use to replace the building at today.
And is that a standard accounting
It is
practice?
actually, in some countries where they introduced inflation accounting, it did become standard. So for example, Chile had very high inflation. In fact, they still use inflation accounting. There's a number of other countries that have done that in the past in Latin America. Israel, for example, used to do it. And some of the countries now are, by the way, going back to inflation accounting because of the recent bout of inflation. Or at least they're trying to accommodate it. But this is kind of well known amongst accountants that this is what you would need to do for proper inflation accounting if one did it.
But the question I asked was, is that what we consider that accountants are doing today?
No, they don't do it. They do book profits and
Okay.
they don't adjust depreciation for inflationary effects.
Okay,
The same thing applies to inventories, and you could buy an inventory several years back and then you try to sell it today. Again, when prices go up and you have to replace the inventory, you're replacing it at a much higher cost than it was before. So that's another adjustment that one would do for inflation. And then the third one actually is one that kind of goes the other way, and has to do with borrowing money. When a company borrows money, debt, it borrows at a nominal interest rate, interest rate including inflation. If you didn't have inflation at all, maybe the borrowing rate would be 2%, but then with inflation, it's 5% or 6%, depending on what the inflation rate is. You just add onto it. And that's because interest is compensating the lender for the loss in the purchasing power of their money that they lent to the firm. So for example, if I'm running Mining Inc. and I go to you to invest in a bond, and there's 3% inflation, well, when I pay you back the bond, the original cost, the bond, the money that you lent me, there's been several years down the road when you get your money back, you can't buy as many goods and services because prices, eggs have gone up and food has gone up and housing has gone up, et cetera. So that's a loss in the purchasing power of the money that you originally lost. So you say, well, if I'm going to give you, if I'm going to buy your bond, I want to get a high enough interest rate that's going to compensate me for inflation, as well as my willingness to lend money to you and postpone my own consumption. So that is, so what happens when under inflation accounting, companies are writing off some of the interest expense, which is really just compensation to investors for the loss in the purchasing power of the debt, because that's a gain to the firm, because the debt, in a sense, goes down in real value. Another way of thinking of it, the firm's assets are going up by inflation, and yet the debt stays the same. So it's kind of like a gain to the firm. So there have been studies done. There were a lot of studies done in the 1970s and 80s on inflation. And I decided to quote one of them particularly, which was done by Glenn Jenkins. And Glenn Jenkins, who was at Harvard at that time, he did a lot of these, he did a number of pieces in Canada. And he was very much one of the key people working on inflation accounting and the impact on profits. And he actually became an assistant deputy minister in charge of tax policy in the period in the 1980s, I think around 82 to 86, I think because of this work. And in fact, you can thank him for the GST today, because that started under his period. Anyway, he wrote this paper a number of years ago on the impact of inflation, taxing, and accounting practices on private and social rates of return in capital in Canada. But the main point of the paper is that he showed that once you correct for inflation on the return on capital, and this is kind of like the profits that Professor Stiglitz and Mr. Hutching were estimating, that instead of getting a 8% rate of return on capital, that when you're taking profits divided by capital, once you do all the adjustments for inflation, increased depreciation costs, increased inventory costs, take into account the debt issue, that actually the rate of return drops from 8% to 5.2%. So you can imagine, if you're trying to measure economic profits, if you don't do inflation accounting for some of the years, especially when inflation was high, you're going to be way overestimating economic profits, because actually some of it is just due to inflation. the size of that profitability.
And Professor Mintz, when you say estimating economic profits, do you mean economic rents?
Sorry, economic rents, right? That's sometimes I've used the word economic profits for economic rents, but yes, economic rents, sorry.
So you mean here that the situation with inflation is that without accounting for inflation, you may be overestimating economic rents?
You're overestimating accounting profits, or you're overestimating real profits. Inflation accounting, or inflation properly adjusted, inflation adjusted profits. And so if you're using, that as your basis of measuring economic rent, because those profits are really go for two things. One is to cover the normal return, the normal profit, and the other part is to cover economic rent. Well, if you're overstating your profits and you have to reduce it, then actually you're going to get a much smaller measure of economic rent. So for example, if you're estimating, let's say $10 million in total profits, and it's not, and you have made adjustments for inflation, let's say the normal return, like you need a 6% normal return on your capital in order to get shareholders to invest in you. But after you adjust your profits, you're just covering your normal rate of return. You could actually end up eliminating all economic rents in your measurement. As a result.
So a shareholder or a financer might end up in the same boat as the person buying groceries, highly affected by inflation.
That's correct.
But is the purpose of pointing out these three issues, the three needs to take inflation into account when measuring profit, is the purpose of pointing that out to show that, is it another demonstration of the impracticality of using economic rents? It's not to say that all accountants should change their practices.
No, I'm not saying that all accountants should change their practices. Although
Although you might.
Although maybe you should. And maybe that would be less confusing for the public, as we've had a big debate about grocery pricing lately.
Okay.
Because again, you have a problem there of not having the right profit measure in the first place. But no, I'm not suggesting that you change accounting practices. What I'm suggesting is very hard to measure economic rent. And in fact, there was no adjustment made by Mr. Hutchings for inflation in measuring his profitability. And so he may have been over, at least in certain periods where you had relatively high inflation, there was no adjustment to the profits. But I am saying that actually, basically, when you take inflation risk into account, and also I didn't talk about the problems of even measuring depreciation, which is another problem, which I could say a couple of words about it in a moment. But because of these difficulties, it makes this attempt to use economic rents as trying to determine how you augment the annuity very difficult. And that's why I go back to the point that really one is better off, I think, just using what you can observe. And I think net crown resource revenues, I think, is a better place to start from. So I have less difficulty with that.
Okay.
So Professor Mintz, again, I'd like to go back to that slide 37 that we looked at before, which I think of as a bit of an outline of what you've been dealing with. Again, you're talking about the value of the resources approach, which is based on economic rents, suffers from limitations, and you've taken us through those. The first one being whether rents would be taxed at 100%. You told us that could also mean whether the government could collect 100%.
Yeah, it's not so much being taxed. It's just the main point, because that's the wording used by Professor Stiglitz. What I'm saying is that it's not possible for the government to collect 100% of rents.
Okay, and then
for the reasons that I gave. And then I'm also saying that even trying to use this approach, which gets to the second point of trying to use this approach of measuring rents to determine how to augment the annuity, it's impractical.
And you've given us those examples about risk, expectation, and inflation. Are there any other reasons that you'd like to discuss about why it's impractical to try to measure value through the economic rent approach?
Well, I think expectations is another one, but I could mention the problems of measuring depreciation. There's a lot of judgment that goes into measuring depreciation. And I'll give you a story behind this. When I was on the board at CHC Helicopter, we ended up with 3 audit committee meetings or 4 on the question of how do you depreciate a helicopter. Apparently, there's 4 different methodologies that are completely acceptable for accounting practices. And one way is you sort of take the whole helicopter and depreciate it over time. And the problem with a helicopter is that the body doesn't change. It can last many, many years. But a helicopter, almost all the parts are replaced at some point during the life of the helicopter for a long period of time. So another approach was to say, well, let's depreciate every little bit, like the rotor blades and things like that. Anyway, I remember we had this very long discussion. How do you even depreciate an asset? And then when you get into something like technological obsolescence, so machinery, for example, could have, there's old machinery and up-to-date machinery. But up-to-date machinery may have new technologies associated with it that are not part of the old machinery. And so actually the old machinery is declining more quickly in value because people are really not interested in buying it, because they'd rather get the new machinery that has new capabilities that an old machine doesn't have. It's a newer vintage as a result. And so economists actually talk about the concept of economic depreciation as being sort of like the value of an asset today, let's say $1, and it depreciates over the year, and it has another value at the end of the year. And that value will change for 2 reasons. One is physical wear and tear. That would be kind of like the bricks falling off the building. But the other reason is that if new technologies come along that is better, it could cause old technologies to the capital prices to fall more quickly, and therefore there's a loss in the value associated with that as well. And so that's another issue. Again, in accounting, they just look at service lives, but they don't take into account necessarily obsolescence, although sometimes they do in accounting practices.
Something everyone is familiar with their phones.
Right. That's a perfect example, or even computers.
And that's called economic depreciation.
Yeah, economic. It actually, there's an article by Paul Samuelson, a very famous economist many years ago. And actually it goes back to I think it was in the 1950s, because I remember reading it as a graduate student that talked about economic depreciation and defining it in this way. And
can you remind us why this is relevant to economic rents?
Why it's relevant is, again, you may be having an overstatement of profits if your depreciation is being measured too low. That maybe economic depreciation is higher than your book depreciation, and therefore your profits should be adjusted. But I will say a lot of experts don't try to deal with economic depreciation and trying to correct profits.
Are we ready then to move to your slide 43, which is your summary
Yes.
of key points?
So this is really my last slide, and it's really just a summary. We follow the principle that compensation to be rewarded to First Nations of RST territory should be based on the share of net Crown resource revenues. And my colleague, Mr. Reardon, will talk a lot more about that when he testifies. Like the atmosphere, we would argue that spectrum is a natural resource, and it is a public resources, but it's not directly tied to land, and therefore should not be treated like land, water, forest, or minerals, and not be included in net Crown resource revenues. As a minor adjustment to expenses, we would argue that the corporate tax credit that was given for the logging tax from 1962 to 1980 should be treated as a federal expense and reduce resource revenues for that reason. And then finally, it's difficult, governments cannot collect 100% of resource rents for a variety of reasons that I gave. And existing resource taxes are not exclusive rent taxes because they do tax the normal return to capital, not just the economic rent. And so when they do actually tax the normal return to capital, that can impact on capital investment and the development of resources. So that should always be kept in mind in terms of the impact that these levies, that they're not pure rent taxes, and they're not going to, and they could have an impact on development.
Thank you, Professor Mintz. That concludes the examination in chief, unless, of course, you have questions that you'd still like to ask Justice Hennessy.
Stop now.
Good. All right. Thank you.
Thank you very much. Now, I know there has been some talk about timing, and I just want to ensure that whatever cross-examination there's enough time for it. I know we're not sitting Wednesday. I don't know how Thursday and Friday can take into account any time that is necessary for this witness.
I just mentioned the schedule. We had scheduled a day for in chief and a day for cross. Neither of the witnesses are available on Wednesday, which is why we're off.
Yes.
And I think we're going to need both Thursday, Friday for Mr. O'Riordan. So I think really we have to finish up with Professor Mintz's cross-examination by the end of day tomorrow. Fortunately, he's not catching a flight, so we're able to stay late if we need to tomorrow.
Well, thank you for that. And let's see what you estimate, Mr. Schachter, and
Yeah, I guess what I'd like to do is I'd like to get started right away.
all right.
And I don't know how long court would like us to go, or if the court needs a 5-minute break. I've got some compendiums to hand out. But I'd like to get started and
Yeah, I prefer that as well, that you get started.
Yeah.
And maybe we take some time today so that you don't feel as crunched tomorrow.
Yeah.
And if there is an early start for tomorrow, my own preference is not earlier than 9:30.
Right.
So,
Well, let's see how far we get.
all right.
kind of thing.
And Mr.
I-
Hong is on his feet.
Just want to clarify that Ontario has no questions.
Thank you very much.
And I'll just add as well that on behalf of the group of 7, we would likely have somewhere in the range of half an hour.
Following
worth of
Mr. Schachter?
cross-examination, Following Mr. Schachter.
Thank you.
I have a couple of one compendium with 2 volumes to hand up. And we'll be getting everyone a copy of that just right now.
Yeah, I'll get him.
You have a copy for Professor Mintz?
Yeah. Mr. Schachter, do I need the original reports from this witness?
Yes. Yes. Or at least a copy of them, because I will be referring to Professor Mintz's reports.
Very good.
All right, I wonder if we could, for the sake of convenience and identification, mark the cross-examination compendiums of Jack Mintz, volumes 1 and 2, as a lettered exhibit.
I believe that's L. Let me just. be sure.
You want them marked as 2 different exhibits, or just L.1 and L.2? If we're up to L.
We are up now. Let's do 0.1, 0.2.
L.1 is volume 1.
would be volume 1, volume 2 would be L.2. All right. Professor Mintz. Can I,
Please start.
yeah, Professor Mintz, my name's Harley Schachter. I'm going to be asking you some questions about your testimony and about your report. First thing I want to ask is, I want to just sort of stick with the last topic you had, which was discussing rents. And would you agree with me that resource rents is another way of looking at trying to assess, find out the value of the resources?
Well, assuming that there's no other sources of rents. It may be, but as I tried to argue that economic rents could reflect several cases where you may have irreproducible factors or some fixed supply.
Maybe I can put it this way. If you're trying to value the resources of the treaty territory from 1850 to 2019 or to the present, is looking at what the resource rents are, if you could figure them out, is that a reasonable approach?
Yes, I think that would be reasonable.
Thank you. Now, I understand you're not in favor of using the resource rents approach to try and figure out the value. Can you point to, in your report, what methodology you used to value the resources of the treaty territory?
That was not something that was asked of us to do. So we did not try to do evaluation. In fact, I have to admit, based on some of the things I said, it would be very hard to do that.
But you haven't done it.
No, I haven't.
Can you open up your, we'll call it, I guess it would be Exhibit 31, which is the trial demonstratives, and go to page 6
Sorry.
of the demonstrative under conceptual observations?
Oh, under my demonstratives?
Yes.
Okay,
Just
sorry.
take a moment. I'm sorry if I'm going too fast. I'll try and slow down.
Not just, I've got a lot of paper now in front of me, so.
Yeah.
Uh,
Was not my plan to bury you in paper.
although it's nice that you have all my number of my publications here.
Yes, and indeed, I may have even read a couple of them.
I won't say poor you, but yes, page 31, did you say?
No, page 6.
Or page 6?
So on page 6, in the first paragraph, you have a definition of net crown resource revenues. You see that there?
Yes.
Now, you may not have realized it, and maybe it was a slip, but in your direct testimony, you attributed the whole of the definition to Justice Hennessy. And I'm going to suggest to you that that's not what Justice Hennessy ruled. And we're going to go through that, okay? Because we want to be clear about words.
Yeah, that's fair enough.
Okay.
If I made an error, I apologize for that.
Okay, so you made a reference to, if you look there, there's a reference to paragraph 10. Now that's paragraph 10 of your report, is that right?
That's correct.
Let's take a look at paragraph 10 of your report. Now, you won't find the words on slide deck page 6 at paragraph 10, will you? And I'll take your time to compare it. The two are different.
Sorry, but sorry, what paragraph?
We're looking at, you identified it as paragraph 10,
Right.
like on slide deck 6. You give a definition, which you say is from paragraph 10. And I went to paragraph 10, and it's those words do not appear in the exactly same form. And I'm wondering, I want to explore if the difference and why there's a difference. Maybe you don't think there's a difference, but We should be clear about it for the record.
Um,
Do you want me to help you?
oh, no, I see the words, expenses incurred to collect, regulate and support such revenues. And the part that's in quotation marks is collect, regulate and support such revenues. Correct?
Yes, and do you appreciate there's a difference between such revenues and resource revenues? And really, that's a question I'm not,
Yes,
I'm
no,
I'm
no,
wondering
I-
if there
I
is.
understand. I understand what you're asking. Well, I guess if you don't have the qualifier resource revenues, it may be a difference. I'm not sure. And what does revenues refer to?
Well, maybe we can get some clarity if we look at the judgment itself. I think you'll find the judgment on exhibit L.1 at tab 2.
Sorry, L20, sorry, I'm
That's one of the big binders.
These new.
right. Am
the
I
new
in
ones.
1 or 2 binder?
L.1 is volume 1 of 2.
Okay. And which number again?
And at tab number 2. And if you go over to at the bottom right-hand page of the page, there's a number 14. And so each one of these,
Sorry, I'm not sure. What page should I be on?
the page numbers in the bottom right-hand corner,
Yeah, I
I'm
got
gonna
that.
make a reference to those are the compendium pages.
Okay,
So what I've done, just so that everyone, so you can follow along, is that we've prepared these booklets of various documents, and on each page, we put a sequential number so that people can try and find it.
yeah, no, that's fine.
You
So just what page are we, do you want to be on?
I want to be on page 14 at the bottom,
14 at the bottom? Okay,
right? It should say page 14 on the bottom right-hand side, and it should say page 9 in the middle on the top. And the first words of the document on this page are "be the treaty to reflect."
Yeah, I
Are we,
got
are we at the same place?
yes,
Okay, so I want you to go down to paragraph 3B, Roman numeral 2.
okay,
And you'll see that the words that the court used, which you don't use at slide deck 6, and you don't use at paragraph 10, is different. And I'm going to read you what the court says. The court says that relevant expenses to be considered are Crown expenses related to collecting, regulating, and supporting relevant revenues.
yes,
And that's different than any revenues. It's different than supporting any industry, right?
oh, it just says with respect to relevant revenues.
Yeah. See, in doing your work, you didn't take that into account, did you?
Well, I'm not sure. Maybe my misinterpretation of relevant is maybe it depends on what you mean by relevant, right?
Well,
Revenues. I
what did
would've
you
thought
think
they
in,
would've-
in
they-
doing, in making your report?
I
What did
thought it
you?
was- I thought
Sorry,
it had-
can we just go in?
Yes, I apologize.
So I mind, and I'm willing to accept, being erred in this, but I think probably what I thought relevant would refer to resource revenues, which had to do with the first paragraph where relevant revenues to be considered are Crown-based or Crown resource-based revenues.
They have to be a matching.
Yeah.
Okay, thank you. Maybe we could then turn to your instructions, and I want to examine your instructions, and if you look at volume 1 of the compendium, exhibit L1 and tab 1, you will find your terms of reference, appendix C to your report. And I'll wait for you to get there at tab 1.
I'm at tab 1.
Okay. Now, if you look at page 7, and again, I'm referring to the compendium, page 7. You were asked at, it's page 134 of your report, page 7 of the compendium. You were asked to review 10 different reports. Is that correct?
Yes,
Did you do that?
certainly. I can remember much of them. This is one story, but I do remember reading.
Okay. So all of those reports factored into your analysis, is that fair?
Whether all the reports factored into my analysis is a different story, because I may have not used a report because it wasn't relevant to the analysis.
Okay. So let's just get right to that. Dr. Dribbin's reports that you read did not factor into your work at all.
No, not in the end.
So you didn't consider any of his work relevant to your analysis.
Correct. Well, at least what I remember of it. Oh, well, he dealt with, there was some that dealt with the number of, population and things like that. And that, though, anyone that dealt with population numbers, was relevant to it.
Right. What about his opinions about the understandings of the parties at the time? Was that not relevant to your analysis?
Oh, I would say it was relevant in the sense that I read that. I read the annuity report too. Forget who wrote that. And you're relevant in terms of my thinking, but it didn't affect, doesn't affect the economic principles that I was doing.
Well, I guess it depends what what you were asked to do. And that's, I don't want to quibble with you. I'm just trying to figure out whether you took it into account or not.
Oh, well, to be honest with you, I don't remember very well. I remember reading the papers and where there was issues that I thought were relevant to some of our discussion. I certainly, I may have even quoted some of it. Some of it, for example, from a couple of reports.
If I was to tell you that I don't recall reading anywhere in your reports, either the main report or the Sir Reply report, any reference to Dr. Dribbin's reports, would you have any reason to disagree with that?
I probably wouldn't disagree that we didn't refer to it.
Okay.
That doesn't mean that I didn't read it.
It's fair enough. And another one of those reports was from a person by the name of Simona Bignami, the population demographer.
That one I remember quite better.
That one you do remember.
Yeah.
And indeed, you do comment about her report at page 77 and footnote 146 of your main report. And I'd like to go to that, please.
Actually, that is, I think, going to be covered by Mr. Reardon.
Okay, this is a joint report. You told me it was a joint report and
It is, but I'm not, I think I would like to leave testimony to Mr. Reardon to deal with this parts of our report.
Are you not able to take ownership of this whole
Or
report?
take ownership, absolutely. I agree with
Okay,
that.
well,
But
then I would like to ask you a question about page 77 and footnote 146. And if you can't answer it,
Well, I
we'll
mean,
deal with that. I mean, but I think it's fair for me to ask. Maybe you know.
I'd have to recall, remember, there was a lot of paper that went with this.
I'll help
And
you.
but there were certain things that I dealt with in detail and other things that Mr. Reardon did, and he would be probably better to discuss it.
Perhaps, but may I want to ask the question is the point. So why don't we go to page 77 of your first report? And footnote 146. And in footnote 146, you identify two concerns with the Bignami estimates. Do you remember having those two concerns?
Yes,
Okay, so you can answer some of the questions. It's not a memory test. I'm not trying
No,
to
no.
trick you
No,
at all.
No, I understand, but I just feel that Mr. Reardon is going to be covering this part of the report, and that's the way that we split the report. Because we weren't allowed to jointly testify. So-
Yeah, I want to test your knowledge base,
Yeah.
okay? So if you
So I
remember,
didn't prepare a part for today.
Well,
Okay, anyway, let's go on.
if you know the answer, that's even better.
Okay,
That's all we need if
Alright.
you know the answer.
so
So,
yes, I do remember this.
all right, and you remember there were two concerns. One of the concerns that you identified is that there wasn't any similar study for the Robinson Huron Treaty Territory.
And that's correct, because we were trying to deal with both at that time,
Right,
because the
right,
report
and
was based on.
indeed.
So this concern is less important now, given this is only focused on the RST.
Would you agree with me that it's of no concern at all? And they're
Yeah.
not just less important, no concern?
So I'm speaking as my usual qualifying way, but yes,
Yes, you agree, it's no concern.
it's no concern. So
Thank
one, the first one isn't. The
Yes.
second one is a different one.
The second one, about no migration, makes it no, sorry, excuse me. It's the second concern is that the Bignami estimates are based on no migration assumption, which is problematical.
Correct.
Would you agree with me that if migration was not a factor, then your concerns about her calculations evaporate?
If there was no migration, but my view is that there was migration.
You're not a demographer.
No, but
You're not a historian.
and now this is where I can't remember the exact details, but when I read the report by Big Mountain, I think, and I may be incorrect in this, and I apologize, Justice, if I am, but if I recall, I think that was even stated in the report.
I will move on. At paragraph 4 of your SIR reply, I wonder if you could pull that up, please. Part of exhibit 30,
Paragraph 4.
yes. You wrote that your criticisms of the economic rents approach was made in the context of questions and tasks set out by legal counsel and framed by the judgments of the Ontario Superior Court of Justice and the Court of Appeal. See that there?
Yes.
I want to discuss both the tasks you reference and the judgments you refer to. So let's deal with the tasks first. One of the tasks you were asked to do was to comment on the theory and methodology of the value approach.
That's correct.
And is it your opinion that the value of the resources is irrelevant to determining the compensation to be paid?
It is my opinion that the value of resources is not a practical approach to determine.
Well, I want to
Sorry, a
distinguish,
practical approach to determine.
Well, a practical approach to determine how to augment the annuity
Thank
goes
you.
back to the many things that I said. earlier.
Okay.
yeah, that's not my question. My question is whether you believe the value of the resources that existed from 1850 to 2019 and even to today, whether that calculation is irrelevant to determining the compensation to be paid.
That calculation?
Yes.
Calculation is irrelevant
Why is it irrelevant?
because it's impractical.
It's
I'm
impractical.
not, I'm saying the calculation, that's an empirical question.
I see, okay. But on a, maybe I can put it this way, and perhaps I'm struggling. Is there something in the judgment or your tasks that led you to believe that what the Anishinaabe, the Indians, I'll call them Anishinaabe if you, is that okay?
Yep.
What the Anishinaabe brought to the table in 1850, the value of the territory is irrelevant? And do you need me to repeat that question?
No, I didn't, that's a different question than the one you asked. First one, anyway. Is it irrelevant? No, it wouldn't be irrelevant. There was a treaty made and a transfer of rights, but I'm not a lawyer, so I don't like making legal judgments about what was actually decided. in the treaty.
Yeah, perhaps I apologize for not being clear. I'm trying to understand what work you did. And so what I'm trying to get at is whether in doing your report, you turned your mind to, maybe I should consider what the value, or sorry, put it this way, maybe you should have considered what it was that the Anishinaabe brought to the table. Did that occur to you as something that might be relevant?
Yes, I mean, when I read, for example, the annuity report, there was a long discussion about the value of the land that was involved.
When you say the annuity report, who are you referring to?
Trying to remember the author's name. It was a big, long report.
Oh, you read Gwyneth Jones' report?
Yes.
Okay. So did you take into account the value of the treaty territory in your report?
We did.
Pardon?
We did in a sense when we talked about land sales. I'm not quite sure.
Sorry, you didn't try and calculate the value of what the Anishinaabe brought to the table?
No, we did not try to calculate value of rents or the value associated with that state.
Actually, keep your voice up a little bit.
Okay, I'm sorry.
Now, maybe I can turn to the judgment itself. And that's at tab 2 of compendium exhibit L1, volume 1 of 2. And again, we're going to go to page 14 at the bottom right-hand side. And this is part of paragraph 2 of the judgment. It's 2B of the judgment.
Sorry, this is on page 14?
Page 14 on the bottom right-hand side, there should be a page number 14.
Oh, I see 2B at the very top, page 9
Yeah,
or 14.
Yeah.
Yeah.
and
sorry.
so it's.
Okay, I didn't know that was 2. Okay.
Yeah, so it says B, the treaty reflects the parties' common intention that their agreement was to allow both the Anishinaabe and the Crown to realize the future opportunities and potential of the treaty territory in a manner consistent with the Anishinaabe principles of respect, responsibility, reciprocity, and renewal, and the intention of the Crown to act honorably with justice or fairness and with liberality or benevolence. You see that there?
Mhm.
And did you factor that paragraph into your analysis?
Certainly we understood, although again, this is where this is where Mr. Reardon is going to be just testifying, and I was not, I haven't really checked into this, but I know that certainly we took that into account in terms of thinking about issues around sharing and other things like that.
So what's reciprocity?
Reciprocity is doing something, returning something for something that someone gives.
It would say
I think.
Getting something in return commensurate in value to what one gives, is that an operative work for you? Does that work for you?
Well, it depends on what we're including and all the various things, right?
No, I don't quite understand that.
Yeah.
If I said to you that reciprocity meant, and
Yeah,
if we
no, I
were to
understand what you're
assume
saying.
that reciprocity means getting something commensurate in value with one gives. We use that as an operative definition. How did that definition I just gave you, did that factor into your analysis? If you don't know, you can say you don't
I
know.
really don't know.
You don't remember
I just don't
discussing
remember.
this. Sorry?
I think Mr. Reardon would be able to answer that question better.
But you don't remember discussing that at all with Mr. O'Riordan.
Certainly, I don't recall.
Might it be the same answer for renewal, responsibility and respect as well,
Uh,
that you don't remember?
Well, let me put it this way. I remember reading a number of the things that were written. And I understood a number of that. And certainly I certainly don't think that we ignored fact that, there's issues around the appropriate compensation that was to be agreed upon as part of the treaty, which it was with respect to the annuity and augmenting the annuity. But that's as far as I recall the details that we dealt with.
Maybe we can examine a little
Okay.
bit more in detail what you said in your main report, not your slide deck, and not your SIR reply about what your task was. Let's go to page 133, sorry, excuse me. Compendium. Exhibit L1, volume 1 of 2, tab 1. These are your initial instructions. It's at page 6 of the compendium. It's page 133 of your report. It's the second page of your instructions. Have you found it?
Sorry, where's?
It's the first paragraph is please review
Sorry,
the
I might be in the
two,
wrong tab. Which tab?
tab 1
Okay,
of the big fat binder.
Yeah.
Page 6 on the bottom right-hand side. I'll wait for you to get there, and it's up on the screen too. Are you there?
Yeah.
It says, please review the 2 court decisions as well as the Superior Court's judgment as amended by the Court of Appeal. So at paragraph, now let's compare that to paragraph 86 of your main report. And I'm going to turn to paragraph 86 of your main report. I hope my notes are correct. It's at page 41 of exhibit 29. And I want you to hold open both of those, right? Because we're going to compare them for a moment.
I'm in the wrong. I looked up the page. On the
So we're comparing 2 things. We're looking at your instructions
right.
and we want to compare them to paragraph 86 of your actual report.
Okay.
Now, we've just taken you to your report where you were asked to look at court decisions as well as the judgment. And at paragraph 86, you opine that the decisions of the Ontario Superior Court and the Court of Appeal provide some guidance on the question of how the annuities should be augmented. And you then go on to reference the Court of Appeal judgment. right? And I have a question here that I really don't know the answer. Do you equate the decision with the judgment and not, or do you mean by decision the reasons? What were you intending to refer to?
I think I'm not clear on your question.
Okay. The way we lawyers use words, there's a judgment which is different than the reasons. And when someone uses the word decision, it's unclear to me as a lawyer.
I feel I should stand up to help because I authored this letter and I refer to please review the two court decisions as well as the judgment. So I think if there's some confusion about the language, it originated with me. And
That's fine. I'm just trying to find out what the gentleman considered. And if, I don't know what he considered.
Yeah.
Maybe if
I
he was,
can explain that in the language I use, decision means the reasons for decision.
oh,
That's what the author meant.
is that what you understood as well?
I believe so.
Okay, so at paragraph 86, when it talks about the decisions of the Ontario Superior Court, you mean the reasons of this Ontario Superior Court?
You know,
Just to
Being-
be helpful, the reasons are 100 pages. Judgments are about 5 pages.
I see. I remember reading it all. This is what happens when you're not a lawyer. That's why I was totally confused by your question. Because I don't understand.
Look, I
the
do not
difference
intend to try and
between- No, I know.
confuse you.
I
I'm
just didn't
just,
understand the difference between decisions and reasons. You read,
do you understand them now?
now I understand it,
Okay.
but I don't recall which is which in terms of what we pulled.
Oh, you can't recall what you looked at.
Well,
You must have looked at the reasons.
yeah, no.
Like
Yeah,
they-
right,
You did?
yes.
Okay. Now, if you look over at paragraph 87, this is why I think you looked at the reasons, at least the reasons for the Court of Appeal. Because you point out that the Court of Appeal there's identified, excuse me, no promise of a fair share. You see that there at paragraph 87?
Yes.
Are you able to tell me why it was important to your analysis to reference the share need not be a fair share?
I guess it depends on what you mean by fairness, but I have to admit, this is, I think Mr. Reardon would be better to answer that question than me. As this is, as he was the primary author.
I'm just asking you what you remember.
I don't remember.
You don't remember at all. At paragraph 88, you reference the Court of Appeals reasons. Do you remember referring to the Court of Appeals reasons at all?
Yes.
Okay.
Remember reading it,
And that's about relative wealth and
but again, I
needs?
didn't write this section, but anyway. So,
Okay, well, wait a second. I thought you said you jointly authored the
I was
reports.
jointly authored, but there's primary authors and secondary authors.
So you don't take ownership of this portion of the report, or do you?
No, I take ownership of the report, obviously, but it's as best as I have it, but as you know, with writing, the primary author can provide a better explanation. I think really, I think justice for you to get the best sense of it, I think it's Mr. Reardon has to give the answers to these questions.
To the extent you can answer, please do. And if you
Yeah.
can't, just indicate that you cannot.
Yeah, okay. So I cannot answer.
So I want to look at paragraph 89. And it says, you're quoting from the Court of Appeal. The parties in negotiations or the trial judge in stage 3 must determine the form, level, and aim of sharing that the augmentation clause requires. The parties in the court should be led in doing so by the treaty parties' shared goals, expectations, and understandings in 1850, and it goes on, but I want to stop there. How, in your report, if at all, did you factor in the treaty parties' shared goals, expectations, and understandings in 1850?
I think it'd be best that Mr. Reardon answers that question, because I don't recall.
You don't recall talking about it with Mr. O'Riordan at all?
No, we discussed it, and there's this discussion around sharing that we have in the report, that actually some of it I did contribute to. But I just don't remember.
Are you able to tell me at all anything that you remember about the expectations of the Anishinaabe that factored into your calculation
Uh,
or your determination, not a calculation?
Well, I think that did play a role in the way that we looked at it, that there was an expectation
Okay, what was the
that
expectation?
the annuity should have been augmented when the Crown could afford doing so.
So that's the extent of the expectation that you understood. Yeah.
That's what I recall best in terms of the material that we looked at.
Now,
including the
in
treaty
preparing,
that's involved.
yeah, sorry.
But again, I'm feeling very uncomfortable trying to answer something which I didn't prepare for, because this is Mr. Reardon's preparation that we did. And I think that you're much better off to get an answer from him with respect to this than me.
It's 5 o'clock now. Now might be a good time to break for the day.
Okay.
Now, 9:30 tomorrow morning might be a good idea, given how far I've not gone. And I will try and work over the night to speed up or be more efficient in my questioning. The paradigm that was used when my witnesses were on the stand, in at least one instance, the witness was told not to take the compendium home at night. I don't see any reason why, if Mr. Mintz wants to take this compendium home, he shouldn't be allowed to. So if that's okay.
You don't have a problem with it?
No, I don't have a problem with it. I mean, this is not a memory test. And if he wants to review it, that's fine. And I have no objection.
So you're free, sir, in case you wanted to tuck in with a few more volumes this evening. You're free to do that.
But you're not free to talk to anybody.
I know that.
It's dinner alone, I'm afraid.
Yes, and it's a reminder that I have forgotten to give throughout, but sounds like you're familiar with it. There's no discussion. Will one of you ask the witness with respect to copyright tomorrow?
Yes.
All right.
Just to be clear, what I'm asking is whether our witnesses waive any copyright they may have in their reports.
Yes.
We will address that and be with the witness and inform the court tomorrow.
All right. So just because you're not going to be speaking to Ms. Evans, it has been a practice throughout this trial that the reports are made available. And in order to do that, it's been advised that we should ask about waiving copyright. People understand. So Ms. Evans will ask you that tomorrow. Okay, thank you. Will, Mr. Schachter, what I wanted to say, or we can go off record now, we'll break the day.